Hello and welcome to a new video. Today we'll learn the five-step model under Ind AS 115, which is a key aspect for revenue recognition. I'll break down each step one by one and walk you through the process with a simple numerical example to make it easy to understand. Now, overview of the five-step model. Step 1, identify the contract with a customer. And step 2, identify the performance obligations in the contract. This is what? This is identification of the transaction. You see, they identify the contract with the customer, then they identify the performance obligation in the contract. Step 3 and 4, determine the transaction price and allocate the transaction price to each performance obligation. This is what? This is called measurement. After the transaction identified, they are measured in terms of money. They measure what is the transaction price and thereafter they allocate the transaction price between different performance obligation. And lastly, step 5, that is recognize revenue when or as performance obligation is satisfied. After the transactions are identified and measured, they are recognized. That means they are recognized, they find a place in the financial statements. So these are the overview of the five-step model. This will be discussed one by one next with one numerical example. First, you see this example. A Limited, a manufacturing company, year-end 31st March, sells a machine to a customer for rupees 4,800 on 1st October 2004, which includes two maintenance services every 6 months. Standalone selling price given machine 4750 and two services 250, total 5,000. Now, step 1, we apply the five-step model. Identify the contract with a customer. A contract contains a promise to transfer goods or services to a customer against an amount of consideration. That means you see, a promise to transfer goods or services contains a promise to that means what? Delivery of the machine and provision of two services. Against what? Against consideration. That is 4,800 rupees. So there is a promise to transfer goods or service. That means promise to deliver one machine plus provision of two services against consideration of, you see, 4,800 rupees. Next, step 2, identify the performance obligation in the contract. A promise to transfer to the customer either a good or service or a bundle of goods or services that is distinct. That means what? First thing, they are to deliver one machine that is distinct, or a series of distinct goods or services that are substantially the same and that have the same pattern of transfer. That is what? You see, a series of distinct goods or services. That means first thing is, when it is distinct, revenue is recognized when goods or services are transferred to the customer. Machine is sold and delivered. And this one, a series of distinct goods and services. This is what the entity provides the same goods and services consecutively over a period of time. For example, a repetitive service arrangement, that is regular inspection and maintenance. So delivery of the machine is distinct and provision of services at regular intervals, that is a series of distinct goods or services. Next, step 3, determine the transaction price. What is the transaction price? It is the amount of consideration to which an entity expects to be entitled in exchange for transferring from its goods or services. It has transferred, it has satisfied performance obligation. Against that, what it has to get? It has to get the transaction price. Now, for performance obligation, satisfaction, the delivery of the machine and provision of two services, against that, if the entity expect to be entitled the transaction price, that is 4,800 rupees. You see, this is the amount of consideration the entity expects to be entitled for satisfying performance obligation. First thing that we need to know that this is determined at the contract inception, and second thing, this is the basis for recognition of revenue. Next, step 4, allocate the transaction price to performance obligation. It is allocated to the separate performance obligation contract based on the standalone selling prices. Here is given standalone selling price. Now, how we allocate this 4,800? 5,000 is the standalone selling price of machine and services, but transaction price is 4,800. That is 200 rupees less. How that 200 will be allocated between machine and services? It should be based on standalone selling prices. Thing is that what is standalone selling prices? That is the price at which an entity would sell a promised good or services separately to a customer. Generally, it is the cash selling price. How it is allocated? This is how this is allocated. 4,800 allocated on the basis of standalone selling price. So for the machine 4750 standalone divided by 5,000 into 4,800. Likewise for services it is 250 divided by 5,000 into 4,800. So allocated 4560 for the machine and 240 for two services. Last step, step 5, recognize revenue when or as its performance obligation is satisfied. We will recognize revenue when or as the performance obligation is satisfied. It can either at a point in time or over time. Revenue is recognized when means at a point of time, or as means over time. Now you see, machine is delivered at a point in time and the services are over time. What is at a point in time? When control of the good or service is transferred to the customer, then machine is delivered. It is transferred to the customer. That means the control is transferred. And over time is what? When the entity's performance obligation creates an asset momentarily, because the asset is simultaneously received and consumed by the customer. For example, here you see maintenance service. It is received and immediately consumed by the customer. Next, what are the journal entries? First entry is this date, contract inception 1st October. The entity receives cash 4,800. That is what? That is the transaction price. So cash is debit. How much revenue recognized? You see this 4,800 allocated between machine and service 4560 and 240. So revenue is credit for 4560 machine and the balance 240 is contract liability. At the end of the reporting for 31st March, contract liability half of 240 is transferred to revenue because they have performed only one service. Remaining one service revenue of 120, 240 is to be recognized in next reporting period. So cash account debit on 1st October, revenue credit, contract liability credit. Contract liability becomes revenue at the end of the reporting period, half of 240, and remaining will be recognized revenue in the subsequent reporting period. This is just a basic explanation of the revenue recognition model, but the full detailed video lecture on Ind AS 115. Please visit indasedu.com. Thank you.